India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. We are starting a fresh week and there is so much ground to cover, especially because the global scene is completely looking very different from where we were looking at it on Friday and, of course, over the last couple of weeks. I'm Prashant. With me, my colleagues Nigel and Surabhi is with us today as well. Guys, hi, good morning.
Hi, guys. Good morning. Some exhilarating sporting action over the weekend, right? With the heart beating for Mr. Sen and also the hockey team. But I think we have an equally exhilarating ride lined up now in the global markets arena as well.
Well, the thing that made me most happy on Sunday was the Indian hockey team, the way we fought back. And, so that was really something special. But in terms of market action, we've got plenty to track, right? Weak economic data coming to the United States. You have geopolitical tensions as well. And the Japanese market getting smacked. Oh, I love those visuals. That's the most positive for me over the weekend. Let's pull in Srijesh, I think, What a keeper. I mean, we were down to 10 men and he, almost made it equal for us with, he stepped up and saved so many goals. But good work by the boys. And I hope a gold is coming home yet again in hockey. It's been a long, long while. And I'm just looking forward to that.
Let's see. Maybe it can happen this time. Fingers crossed.
Absolutely. Fingers crossed. And, we'll sort of talk more about this. But let's get this straight down to markets because that's essentially... looking a little troubled as well. I'll start with where we left off on Friday, essentially. You had, the data which I think nobody really was paying too much attention to. And that is the one data which mattered. I'm talking about the US jobs number, which came through on Friday. And it triggered, a sea of multi-sigma moves. I think about 70-75% of the moves that we saw across asset classes were one standard deviation above. And you had many which were, 3, 4, 5 standard deviations above the normal. So, really large moves. The data itself, so US added 114, this is the non-farm payrolls number. It added 114,000 jobs against expectations of 175,000. And the unemployment rate has also risen to 4.3% from 4.1%. Now, markets, of course, got a jolt. It's a seriously low number as compared to expectations. And, essentially, from looking at a soft landing, markets basically moved to recession kind of odds. That maybe we are in a situation where a recession is already, beginning or but it was a lot of extrapolation which happened. Shock value, equities, everything sold off. By the way, there is, of course, one indicator which suggests that the US actually may already be very close to or already in recession. We'll talk more about that as we go along. But equity sold off hard. S&P was down 2%. NASDAQ was down 2.5%. The Russell was sold off as well, about 3.5%. So these are deep cuts coming through. Wix at one point jumped to almost 28. And then, of course, it ended at about 23.5, 25% higher on the CBOE Wix. The 2-year, the front end of the yield curve lost 26 basis points. We are at 3.87. The 2, the 5, the 10, the 30 all lost over 20 basis points each. The reaction of the 2-year absolutely correct and in line because markets are taking up the odds of Fed rate cuts very, very sharply higher. So dollar index also was down 1% to about 103. Essentially, the bet is that, if you got a global slowdown, the US was a bit of an outlier. The US also is looking like it's slowing down dramatically. And if that is the case, you essentially are to expect a lower dollar. Fed cut pricing soared after the jobs data. So markets are now expecting 50 basis points worth of cuts in September and November and a 25 basis point cut in December, January and March. So for the rest of this year, you're basically looking at 125 basis points of rate cuts. So, really rate cut expectations skyrocketing. We've not heard Fed speakers reacting to the jobs data. So if, as and when they do, I think that becomes important. You also have a few other data points through the course of the week. Oil was down 3%, broadly a big risk-off kind of a session is what we had on Friday. And this morning, most Asian markets are lower as well. Let's come back to levels here, right? Because one thing we know, you look at the reaction of the market here on the day of the budget, the capital gains tax hike, you look at the election mini shocker, you look at other data points, the market here has been Teflon coated, right? I mean, you've thrown anything and everything in this market and it does react once in a while for an hour, 2 hours, half a day at best, and then it moves right back up. I just want to say one more thing. The Nifty only corrected last week. It ended down last week. But if you look at the other indices, most other indices, including the Bank Nifty, they all started correcting about 3 or 4 weeks back. And actually last week, if anything, the other indices started to come back up. So there is a bit of a lead lag going on. So I think it would be wrong to just look at the Nifty and the way, it is set up. The rest of the indices, especially the Nifty Bank and a few other sectoral indices, are looking like they may have already actually corrected a little bit over the last few weeks, and they actually are starting to come up. So I just wanted to sort of put that caution on board. Don't extrapolate the big gash across global screen to the market here. Levels then, supports for the Nifty come in at the 20-day moving average, which is 24,588. Below that, you're basically looking at supports coming in at about the 24,200 level. The Nifty spent lots of time around these, around the 24,200 level, so should act as a bit of a support. For the Bank Nifty, watch Friday's low, which is 51,087 first, and then the swing low, which is 50,438 on the way up. I think we can talk about the way up when the way up happens, but for the Nifty Bank, that is the 20-day moving average, which should act as a resistance, which stands at about 51,953. The GIFT Nifty will come up on your screen, and I think we will start around some of these supports that I was talking about. So 350 points lower right at the word go this morning. Surabhi.
This buy on dips is really going to be tested for this market right now. The resilience of the Indian investor, all the money flow that's coming in. Will the dip be bought again? We've absolutely sort of, been cruising past any kind of negativity for the market. So this is another test. It's a global test. And let's see what happens. Prashant, I guess you mentioned the new rule. That's the SAM rule, which is flashing red in terms of recession. It's
not quite there. It's point. It's I think about 80% there, 85% there, but another 15 basis points, and you're officially looking at. It's a so-called SAM rule, right? It's a Fed economist who came up with that rule. And we'll. It's one of the indicators which people are watching.
Okay, absolutely. So, well, you've got I look at it as quadruple blows for the market. One is this non-farm payrolls data, which was exceedingly negative. The second is a tech sell-off, really accentuating in the US and getting more negative feedback from companies. Look at Intel, down 25%. Because of the earnings miss, because of the layoffs that they're announcing. Amazon, again, missed estimates. The Amazon stock was down 9% during trading hours and continued to sell off in post-market trading as well. So you've got US tech, just sheer numbers, corporate numbers not adding up. The third blow is coming in from Asia. Look at the sell-off in Asian markets. Markets are down anywhere between 3% to 6%, with the Japanese markets, some of those indices cratering 7% in the morning. Now, what's happening here? The whole yen carry trade has come into question. The yen surged all the way to 160 plus, or rather, dramatically fell to 160 around the starting of July. In the last 1 month, it has surged 8 to 9%. And today, if you look at the yen-dollar equation, that rate is now hovering around 145. So the pace of the rise of the yen has really caught a lot of market participants by surprise. And it's leading people to question whether the whole concept of the yen carried trade, because it's a currency where interest rates are so low, so you borrow cheap, then you go invest in high-yielding assets, whether a lot of that is getting undone in the last couple of days as well, and whether, it's the starting, beginning, middle, or end. We'll ask our guests as we go along. The fourth blow comes in from the Middle East. You don't know what's happening over there. A lot of hectic geopolitical action over the weekend as well to keep Iran and Israel from really, doing a face-off with each other. But that remains a watch point. Oil fell, of course, on Friday because of the recession worries. But let's see. Hopefully, the Middle East will not add more to the issues over here. Just quickly back home, some of the results of the weekend were also a mixed bag. Divi's was a miss. Britannia margin slightly lower than expectations. The top line seemed fine. On SBI, the numbers are okay. There's a small margin compression of 12 basis points. But let's see, depending on the market's mood, whether you'll start looking at the negatives, which is the rise in slippages, which is the rise in provisioning. It all depends on the market's mood and positioning, and we'll see how that plays out. Last but not the least, fund flows for the record. As usual, DII is net buyers of almost 3,000 crores worth of stock. FI is on the sell side, about 3,300 crores sold off. So we have a lot happening this morning.
Well, the Japanese investors must be wondering, right? They waited for more than 30 years to see fresh all-time highs.
Yeah.
And in a matter of, 10 days or so, they've given up close to around 15-18%.
Absolutely.
Wait for 30 long years, and then, in fact, you get that sort of result. But let's tell you about the Indian markets. And, domestic flows are going to be top of mind. And keeping in mind the kind of domestic flows we have seen, I expect the Indian markets to continue to outperform. And there are a couple of positives as well that are coming through. One of them is in Friday's trading session, if you look at it, towards the last hour of trade, we did end at the low point of the day. So in that case, the traders and the investors here, they were prepared for a weak handover. Preparation because the last tick was at the day's low. The other positive was, in Friday, yes, we were lower, but we outperformed some of our Asian peers. So those are the two positives I'll take away from Friday's close. What about the FIs? Well, the net long contracts have come down. And I like to see some shorts getting into the system. So I'll prefer that, in fact, this number comes down further and we get some shorts in the system. The other factor is the client positioning. Well, they cut their short positions. At the first sign of a bit of a dip, those shorts did cover out. So that's a positive as well, because remember, the clients have been getting it right. So if we get this number back in the positive, then that will give you a sense of how they are viewing this market in the futures and options space. Moving to the options data then, the PCR, that's come down to around 0.91 odd. To give you a reference point, normally we see it bottom out when it goes to around 0.7. So there is some distance to go on that side. But there were two strikes that were fairly active. 24,800 call, well, that was active in trade, 40 lakh shares out there. While the 24,700 put, 10 lakh shares getting added, 166 rupees. So for those writers, they'll be looking at that 24,500 mark as a very, very crucial number. And if by the end of today, we can end somewhere around the 20 DMA or maybe above that, the bulls will say it's a job well done. Because if you break that support level of around the 24,500, then you're heading to the previous resistance level, which is at around that 50 DMA, 23,800 odd mark. The banking space is going to be very important. And HDFC Bank, even in a weak market, that ended with a gain of around 1.2%. The last week, it was up more than 3%. And that's telling you that it wants to defend this 20 DMA. It's managed to close above that mark. So there has to be some firefighting that's done. HDFC Bank is the one I'm looking at. And in that context, since SBI's numbers, if you could look at the positives as well as the negatives, but there wasn't anything very, very negative. And the stock had corrected close to 6% getting into these numbers, 5 to 6% approximately from higher levels. So on the Nifty Bank, well, we'll be tracking a few levels. The 50 DMA is important out there on the Nifty Bank. That comes up for you on the screen. And the recent support zone of around that 50,500, which is a 5% correction from the top. So we start off in the red. I think at some point of time, if the global cues stabilize a little bit, we could see a bit of a fight back.
Oh, absolutely. And, to add one more positive beyond all the cues that we've discussed, states that have been at the margin in terms of just the economic growth of this country, they got investment over the weekend. The Tatas are setting up a new semiconductor facility in Assam. Ambuja announced a new grinding unit in Bihar. So beyond all the cues, I see that as a big, big macro positive as well. So let's not lose sight of the positives too. Moving on then to the equity call of the morning. Chris Wood of Jefferies says the moment that greed and fear has been waiting for, what seems like an eternity, finally has arrived on Friday. That is, he says, unambiguous evidence of a weakening in the U.S. labor market at a time when inflation is still above the Federal Reserve's 2% target. He adds the reaction of the money market shows that investors share greed and fear's long-standing view that the Fed, in the event of such an outcome, will prioritize the labor market over inflation. He says money markets are now discounting 116 basis points of easing by the end of this year, whereas before the payrolls data, it was only 86 basis points. He says an intra-meeting cut, the first time since March 2020, now looks likely.
All right, well, that's Christopher Wood of Jefferies with his thoughts. Let's get you some money market views. This is B. Prasanna coming in on the rupee says, dollar weakening after the weak jobs data has made rate cut pricing more aggressive alongside reducing interest rate differential. Risk-off sentiment triggered by escalation of conflict in West Asia accentuated the carry trade unwinding. The rupee, however, underperformed the dollar as RBI and oil companies were reportedly buying dollars. Equity-related outflows are near-term headwinds for the rupee, and he sees the USD-INR pair trade between 83.65 to 83.95 to the dollar this week.
On bonds, Prasanna says recent data releases in the U.S., particularly labor-related, turn out to be much worse than expected, resulting in market pricing in over 100 basis points of cuts by the U.S. Fed in the current year itself, as FOMC also hinted for commencing rate cuts from September onwards. He says global yields rallied sharply, fearing recession in the US. He expects the MPC to sound dovish, even if it does not change its stance given the favorable domestic factors and turning global factors. He expects the bond market to trade with a positive bias and the 10-year benchmark bond yield to range between 6.8 to 6.95%.
Okay, let's get some opinion in straight up. Rajiv Agarwal, Managing Partner and Fund Manager at Doordarshi India Fund, and Arvind Sanger, Managing Partner at Geosphere Capital, are joining us to run us through all that has happened and what they see, the impact here. Gentlemen, good morning. Good to have both of you here. Arvind, so we've not had one of those big days like we had on Friday in a while. So first, your sense, is the reaction in the US itself a bit of a overreaction? I mean, is this too much extrapolation going on, and will things settle down there before we talk about the implications here? Arvind, go on.
Well, I would say, it's interesting that the market had a huge run-up prior to this shock. So I would say the market PE is still 29 times on the S&P. An overreaction would be if the market had gotten very cheap because of that. All it's gone from is very expensive to somewhat expensive. So, I think we get into this recency bias, right? That whatever the market was at the high a couple of weeks ago is the right number, and anything that comes off that is a big correction. My point is the market was on this optimistic high, that we were having this perfect soft landing. Everything was hunky-dory. Inflation is defeated. Fed is cutting rates, and the market went bananas over the last, several weeks, months. And what has just come back is some recognition, not a certainty, but some recognition that the probability of a recession has gone up. So the market has corrected, but not corrected to a level where you could say, wow, we've already discounted all the bad news. We're just starting to recognize that maybe the risk is two-sided and it's not just a one-way street. And so in that sense, I think, I don't think it was an overreaction. I think it was overdue. I think there was too much optimism. And the risk of a recession is real. I don't think it's, a certainty, but it's certainly a reasonably good probability that we could dim it to a recession.
Arvind, the second quarter GDP numbers just came out in the US, right? You have quarterly earnings. I mean, these are two data points which I can think of, which kind of a recession two questions. One, do you think we will see a recession? Some are saying we already are in one, right? And second, what kind of a recession? We had a recession back in 22, a technical recession. Markets barely did react in a big way at all. It just sort of carried on. Unless you get a profits recession, do you think it'll do real damage?
Well, so let me just go through the companies that reported negative consumer demand. McDonald's, Hershey's, Kraft Heinz, Amazon. This is a very broad cross-section of companies that are seeing consumer sentiment and consumer spending slowing down. This is not, some small subsector of the economy. So I think, if you're not in a recession, the probability of a recession starting in the fourth quarter is probably at least 50-50. And I don't think the market's discounting that, but that's my personal view. Time will tell whether that turns out to be true or not, but we're seeing a lot of signs of consumer starting to weaken. Now, you're right. June quarter consumer demand hadn't yet slowed down as much as it has now, or maybe it started at the end of June. But, some of these companies are reporting in June quarter that they already started to see disappointment. So I think that, these things, we don't have a recession till we have a recession. It doesn't come with a, warning label, neatly labeled that, second quarter was strong. Therefore, third quarter can be a recession or fourth quarter can be a recession. So I don't know. My view is that the risks have gone up.
Sure, and that's really reflecting in the way asset prices have moved in the last couple of days. Got that. Let's bring in Rajiv into the conversation as well. Rajiv, what's compounding the situation and the complexities? What's happening in Japan, right? Because now I don't know if you could hear the call made by Jefferies just a while back. For instance, Jefferies is saying that we could get an intra-meeting cut. The Fed could realize that they've been late and maybe they don't even wait till September. So that's what's happening in the US. In Japan, you've got rates going up and you have this surging yen situation. And that's where I think we realize we all are reminded that the money flows are interlinked between such large markets. What do you make of this whole situation with the yen carry trade, and what could we be looking at in the near future as some of this unravels?
I think it's very interesting. Most of the time, the central bankers move together. And after a long time, we are seeing that Japan and US are possibly on a different course. I think just coming back to the US and this talk about the intra-meeting cut, definitely it is gaining a lot of ground from what I see here. And I was on your call earlier hearing what Jefferies' Chris Wood said. And so it does seem like there is the risk of negative events has increased the probability that the Fed will move. Now, whether the Fed does a 50 basis point cut in the September meeting or they do a pre-meeting cut will tell us much more about how they are thinking. So I think that's on the Fed side. But on the Japan side, clearly the yen was weakening very aggressively in the first 6 months. And only in the last few days, we have seen a significant strengthening of the yen. I think these cross currents will play out. Clearly, the geopolitics is only adding, making the whole thing much more murkier. So I don't think there is a clear view. I personally think this is a time for us to be watchful and take actions only when something looks really compelling.
Okay, all right. Hi, Rajiv. Hi, Arvind. Good morning and good to see you. And Rajiv, you've been investing in various stocks and normally you name, a few of them as well. Suppose we see a pullback, on the headline index itself, a couple of percentage here in India itself. Where all will you be looking to buy? You've mentioned in the past that private banks is something you like, select NBFCs as well. So what would be the top 2-3 ideas that you'll be looking at?
Yeah, Nigel, great to be on your call again. So I think the ideas have not really changed too much from last time because frankly, if you think about the banking sector or the NBFC sector, those are still where there are some value plays out there. But beyond that, as we know that the market has been on a one-way street, just given the liquidity that we are seeing in the market. And therefore, it remains to be seen how much of a pullback we get here. But I think those names which we have talked about in the past possibly still may give us some value if there's a pullback.
Arvind, let's come to India here and now. Till now, this market, as to borrow a phrase from Prashant, it's been Teflon coated, really, right? You throw anything at it and the market bounces in a matter of a day or two. Not sure if it's going to be different this time or not. Your thoughts and whether you still advise buying every dip here?
Well, I agree with what Rajiv just said. I would be patient. I don't believe any market is bulletproof. If investors think any market is bulletproof, unfortunately, they might learn the lesson the hard way that a global, economic risk-off, there are no places you can, hide. But within markets and within India, there are sectors that are less susceptible. Look, things like, chemicals, metals, IT, a lot of these sectors are dependent on global factors. So you can't go hide in those sectors and say India is not going to be affected by what happens. But if you look at the financial sector, the leading private sector, high quality banks, or you look at some, infrastructure, power related domestic facing companies, that's where you should find places where the growth story should be largely unaffected by what happens. But, the Indian market is made up of companies that serve a variety of sectors. IT is obviously a big part, petrochemical, chemical. There are many sectors that are definitely not immune to what happens globally. So I think one has to distinguish between global risk-off and sectors in India which should be largely unimpacted by this.
Okay, all right. Rajiv, before we wind up, I wanted your comment as well. Warren Buffett's selling 50% of its holding in Apple. How do you read that?
Yeah, I think that's a very, very good telltale sign for us that obviously Warren is worried about what is going on in the markets broadly. But clearly, Apple at current valuations is not cheap. Its iPhone franchise has not grown as much. So I think Warren, being Warren, has been able to take good advantage of the current prices and reduce it quite dramatically. I mean, look at his cash position, $277 billion, right? So he really has the firepower to take advantage should there be a pullback. And that is why he's Warren.
Absolutely. Gentlemen, we'll chat more. Thank you very much for joining us for now. Appreciate you coming on, Rajiv and Arvind. Good speaking as always. Well, we'll take a quick commercial break here. Our first on the program today. a lot of conversation around what's happening globally, and we'll keep that up. But there's also stocks to discuss here with news flow, earnings, and otherwise. Our research team joins in on the other side. Stay tuned.
Welcome back. So we're bracing for impact here, considering how global markets are doing. But let's look at the cues back home. A lot of earnings came through over the weekend. So we've got our team standing by with all that we need to know. Let's start off with, of course, big earnings coming in from State Bank of India. Ritu, how did the numbers look?
Well, Surabhi, a slight miss on the numbers compared to our poll. Profit flattish at 0.9% because of a sharp rise in loan loss provisions, and net interest income growing by about 5.7% over the previous year. And sequentially, of course, both did see a decline. Margin saw a dip of about 8 basis points over the previous quarter at 3.2% because the yield on advances dropped while the cost of deposit was largely flat. If you look at the asset quality, while the gross and net NPA ratios are stable or even improved, slippages were sharply higher at about 8,707 crores compared to about 3,900 crores in the previous quarter. But the management is not overtly concerned about this because they attribute most of this to seasonal factors and one-offs that are going to rectify in the quarters ahead. The advances growth was good at more than 15% over the previous year. Sequentially, it was muted, but no surprises there. But deposit growth at just a little over 8% compared to the previous year is sharply below the 11% odd level that we're seeing for the system. But in terms of guidance, it is strong. Credit growth of about 14 to 16% for the year. Credit cost at current levels are below 0.5% and margins between 3.2 to 3.4% kind of levels.
Okay, Ritu, thanks a lot for that. Well, let's hop across to Mangalam here, who's here to tell us about Titan. Hey, Mangalam, morning.
Good morning. So Titan's results were muted, and the good part is we knew it would be muted because the company had given us the cheat sheet, and the thing is that the numbers weren't much worse than what the street had anticipated. So if you look at the revenue, the EBITDA, the margins, the net profit, actually they've been largely in line with muted expectations. The stock actually had seen a bit of a sell-off post their first quarter update as well, but there are green shoots in this performance as well, in which I believe would keep the stock afloat in today's trading session. The first part is that gross margins in the company in the first quarter, along with EBITDA margins, have both been stable. If you adjust for the bullion, the jewelry EBIT margins have actually improved by 20 basis points year on year. Then you have the triggers of festive and wedding season ahead, along with the tailwind of lower customs duty announced in the budget itself. What's not good, however, is the buyer growth was just 2% this quarter, perhaps on account of heat waves and lack of wedding dates, etc. Studded share at 26% was unchanged, and high-value solitaires sentiment was subdued, telling you about a latent impact, perhaps, of the lab-grown diamonds. So those are a couple of factors that we will put forth to the management today.
All right, Mangalam, thank you very much for that. Well, Divi's Laboratories also reported numbers. Ekta is here with details. Ekta, morning.
Well, thanks for that. Well, Divi's Labs, it missed estimates in terms of what the consensus was working with. So revenue up around 19%. Street was anticipating a 23% growth. EBITDA came in at around 622 crores and margins came in at around 29.4%. Street was anticipating around 30-odd%. And profit was also a little below estimates because the tax expenses were higher this year. However, the commentary seemed to be largely on the positive side. So, for example, the company said that they are seeing opportunities from the Biosecure Act. They are seeing opportunities in phase 2, phase 3 molecules as well. They are positive on the GLP-1 opportunities, and the management maintained their growth guidance at double digits for FY25 as well. So overall, maybe the valuations could probably weigh a little bit when it comes to Divi's Labs, but based on what they reported and based on the commentary especially, the stock should be in the green.
Okay, all right, got that. Thanks, Ekta, for Divi's. Back to Mangalam then. Mangalam, for Britannia, I think that margin was below your poll, but overall, how does it look?
Overall, it's a good number, and irrespective of the margins, largely because in the last quarter itself, Britannia called out recovery in rural, and that's panned out even now. And the way they've been expanding their presence in rural, they should benefit from this recovery. Why do I say that? Because revenue growth has come in at around 4,250 crores. The street was expecting a number just shy of 4,200 crores. The EBITDA 754 crores, not much below street expectations of 775 crores, and the net profit at 500 crores as well, marginally below our expectations of 530 crores as well. The domestic volume growth, that is coming at 8%, and that's the higher end of expected 7 to 8% range. And the company said that the rural market share has grown at a faster clip than urban, and they have increased their presence there, so well positioned. Their earnings call is at 10 a.m. today. So up until then, we see the stock slightly, dilly-dallying. But more importantly, the commentary from the con call will be crucial to watch out for. My sense is it would see some green today.
All right, Mangalam, and you'll give us an update on that front as well. So we'll keep an eye out on that. For the time being, let's hop across to Vamakshi. She's here to tell us about LIC Housing Finance. Morning, Vamakshi.
Well, good morning, Nigel. Going with the red for this counter because disbursements have seen a sharp fall sequentially, down nearly 29%. 12,915 odd crores. AUM growth was also rather muted, was up only 4.4% YOY and was largely flat sequentially. On AUM growth, the management believes that clocking 10% growth would be challenging. So this year they're targeting somewhere around 8+% growth. The NIMs also came in at 2.76%. This is a very sharp fall on a sequential basis, down from nearly 3.15%. The management also has revised its guidance for NIMs. They now guide for 2.75 to 2.8% NIMs as compared to earlier guidance of 2.7 to 2.9%. NII came in at 1,989 crores. This is lower than what we were expecting, a downtick of almost 10% YOY and 11% sequentially. The asset quality, however, was rather steady. GNPA came in at 3.29% and NNPA at 1.68%, but the net profit was down nearly 1.8%, but on a YOY basis, but was up nearly 19% sequentially. So overall, given muted growth in AUM as well as the contraction in NIMs, going with the red for this counter.
All right, Vamakshi, thank you very much for that. Well, delivery is the other one, which is going to be in focus on the back of earnings. Back to Mangalam. Mangalam.
Well, new age companies have seemed to have done well this quarter so far. So delivery as well, the third straight quarter of positive EBITDA. The operational turnaround continues for them. And they've also changed their depreciation method. So as a result of which, that's aided their net profit by close to 39 odd crores as well. Revenue growth of 12.6%, EBITDA coming in at 97 crores versus a loss of 13 crores. Net profit coming in at 54 crores versus a loss of 89 crores. Even if you take away the benefit of the depreciation, it is a positive. Express Parcel out there, the volumes grew by about 0.5%. Revenue grew by 6% and margins improved to about 18.2% mark. But it was the part truckload business that led to an improvement in operating and revenue performance. The tonnage growth out there was 16%, revenue growth of 25% out here as well. Margins came in at 3.2%. Same time last year, it was a negative 8.5%. So that was the big swing factor. See green on delivery.
Yes, absolutely. You wonder if you can do a Zomato today. Maybe not that much in price terms, but just in terms of market enthusiasm. Thanks for that, Mangalam. Let's move on, talk about IEX. Vivek, morning. So we had volume data. How does it look?
Well, good morning. You know, what actually happened is the company has given the operational update for the month of July, and it's a strong volume print that the company has given. So on a year-on-year basis, volumes have grown overall basis almost 56%, coming in at over 13.3 billion units. This also indicates that the company has most likely gained market share compared to its competitors. Now, talking about the total electricity volume, that includes largely the day-ahead market, it's up 29% on a year-on-year basis, coming in close to the 10 billion unit mark. Green electricity volumes, has gone up almost 3.5 times on a year-on-year basis off a low base, and renewable energy certificates up almost 5x on a year-on-year basis, also off a low base. Now, when you talk about the real-time electricity market volumes, that's up 31%. So overall, very strong volume print, except some, expect some green on the stock as far as the IEX is concerned.
Okay, some green, we'll take that. Thanks a lot for that, Vivek. Well, let's wind this down then with Ekta on Narayana Hrudalaya. Ekta?
Well, Narayana, came out with a largely in-line set of numbers. We had the revenue up 8.7%. Kotak was anticipating a 9% growth. EBITDA came in at 303 odd crores versus estimates of 306 odd crores, which resulted in a margin of around 22.7% and a profit growth of around 9.5 odd percent. Overall, the parameters look good for the company this time as well. So I'm going with the green for Narayana.
Okay, all right. Thanks very much, Ekta, for that. Sudarshan is now joining in on Amar Raja Energy and JK Tyre. Sudarshan.
Good morning, Prashant. So we'll start with Amar Raja. Earnings have improved year-on-year and volumes were led by two-wheelers. Talking about the headline numbers, revenue has increased by 17%, EBITDA was up 19%, margin has risen 30 bips year-on-year. Company says for the automotive segment, volumes registered significant growth in two-wheeler segment, while four-wheeler volumes saw a tepid demand. In the industrial segment, volume growth overall was moderate. For JK Tyre, it was a mixed quarter. Revenue has slipped and it was dragged by OEM segment. Margin, though, has increased 140 bips. Company says pricing and premiumization have offset raw material cost pressure. Revenue marginally was lower due to decline in the OEM segment, and exports have recorded double-digit growth. And going forward, festive season and favorable monsoon will be key triggers for the industry. So I'm going with green for Amara and red for JK Tyre.
All right, got that. Thank you very much, Sudarshan. So let's quickly recap our list of top stocks to watch. It's a long list today. The ones that have positive news flow are SBI, Titan, Divi's, Britannia, Delivery, IEX, Narayana Hrudayalaya, and Amara Raja. Stocks with negative news flow around them: LIC, Housing Finance, and JK Tyres. Okay, so that's the stock list for the morning. But back to the big global picture with that sell-off, really intense, not just across equities, but of course commodities have been really wobbly as well. We have Manisha with the latest. Manisha, so lots going on. What do you have your eye on?
Oh, absolutely, Survi. If you look at the crude oil prices, I'll start with that, and we're trading at a multi-month lows onto this one. 4 straight weeks of decline for this, and the way the US dollar index has been declining seems to be giving some support to the markets right now. So after nearly 4% of a cut in the previous week, the crude is trading 0.5% on the higher side right now. It also has to do with the Middle East tensions, which seem to be flaring, with Iran vowing retaliation for assassination of their Hamas leader. And then it also is about the decline in U.S. inventories. But the metal prices have continued to decline as well. The previous week saw copper, aluminum, zinc prices decline anywhere between 2 to 4%. It's trading at a 4-month lows for copper and aluminum. But with the China services data coming in slightly positive than the street anticipation, there could be some opportunity buying in metals as well.
Okay, all right. Got that, Manisha. Thanks very much. That's the commodity roundup. By the way, just pointing out that in Asia, it's not just the Japanese market, which is down 5%. The South Korean market is down 5.5% as well, because it's so closely linked to, of course, a lot of the tech-heavy sectors out there as well. So big fall. Taiwan's down 6.5%. So they're deep cuts.
What has happened is that NVIDIA, there was I was reading a news report that the new chip, which is the Blackwell chip, they've kind of delayed the launch of that particular chip. So I think that is the reason why markets like Taiwan, the Taiwanese market is very big on semiconductor stocks and the semiconductor sort of value chain, the supply chain. That's the reason why you've got sharp cuts coming through there. Specific reason with regards to NVIDIA, which has been such a leader really. But I think we have Prakash Devan with us. Najib?
I think, I'll tell you what, I think we'll slip into a short break. We come back, we'll get chatting with Prakash Devan. We'll get to some fundamental analysis. Don't go anywhere.
Welcome back. So will the bulls manage to prevail once again? That's the question as we are gearing up for the Indian market open. We have Prakash Devan with us. Prakash, happy Monday to you. I don't know how happy it's going to be depending on positions, right? But let's start with Britannia. The reason I'm asking you about this stock is market positioning. Stock hasn't done much. Generally, we're going to be in a risk-off mood today. And then we've got earnings over the weekend. What's your call?
Good morning, Survi. So thank you for the lovely wishes on a Monday morning. But yeah, this week is going to be tough. And what the global markets are telling us is that it will be better off focusing on stock-specific activity within our markets. From the results season, yes, Britannia has been, the expectation always tends to be high when you come off a good, market level of sorts. And from that perspective, there was this issue about certain margin reduction and all of that. But let me tell you, these are companies that are actually going to be moving much more significantly given demand, revival rather than just a quarter here and there. And if there is any indication from whether it's a monsoon, whether it's a spending of the government, there is going to be adequate demand revival happening for most FMCG plays. Britannia is probably not as rural facing as probably a Dabur or an HUL would be. But I would believe FMCG is going to be a very interesting space to be in. You may not be able to hide all the time, but at least you'll be better off than being in a lot of the other frontline economy-facing sectors. So from that perspective, these numbers actually give you a very good entry point. The risk reward, in my understanding, is favorable. Expectations probably were not met, but the numbers are still very good as compared to what they could have been, given the tight input side. Yeah.
Okay. Hi, Prakash. Good morning. Let's talk about SBI. You know, the good news, I think the good part of it is, in the last two sessions, the stock corrected from around that 890 rupees to around that sub 850 rupees. So if there was going to be a disappointment, part of the disappointment is in the price. I think a couple of factors could weigh on the stock. That was the credit cost perking up a little bit. And also the deposit growth isn't as much. But otherwise, things look good. How are you viewing the stock at around 850 rupees?
Good morning, Rajat. So, you know, very correctly said, there is nothing which is dramatically wrong. But yes, you could kind of, again, see some sort of a mismatch given expectations. But if you look at what SBI has been doing in this particular quarter every year, last 3 years, let's say, there have always been slippages which have been very stark, which has not happened. There's not been too much of provisioning, so the PPOP is fairly decent. And I would believe SBI is standing at the cusp of a growth cycle where as soon as credit expansion happens, and you know, we are right at the end of that interest rate peaking cycle, and the cost of deposit will probably not go up significantly from here at all. But if credit growth picks up, these numbers tell you that SBI will definitely make the grade. So from the larger banks, I think even compared to the private sector banks, the SBI numbers are fairly the growth slowdown or sluggishness and all is across the board. So I don't think there's anything exceptional about negative about these numbers. But yeah, the market will probably react negatively and give you that. At these levels, the risk reward, probably 800 levels, closer to 8, it becomes even better.
Okay, fair enough. So let's see what today's interpretation looks like. Prakash, just hang on. We have quick earnings calls to go over as well. Affle India is on the radar. The company's come up with a steady quarter. Revenue growth looks quite strong. There's margin expansion as well. And we have Anuj Khanna, Soham, founder, chairman and CEO at Affle India joining in. Anuj, great to have you on. I just want to start by understanding the revenue growth number. I think you've done closer to 520 odd crores at the top line level, which is about a 28% growth. Now, is this organic plus the recent acquisitions? Is it all organic? So we can do a like-to-like comparison, because I think organic growth in Q4 was 18%. Everything put together was around 42%. So could you just break the number up for us?
Hi, good morning. Well, thanks for having me on your show this morning. Yes, our revenue growth has been consistently robust. This quarter, the organic growth was over 20% on a consolidated basis. And yes, together with the acquisition, if you look at it, it's almost 28%. But I think what's very important is to look at how the bottom line performance of the company has been. If you look at, the consistent growth in our EBITDA, delivering over 20% EBITDA, and this, substantial growth even in profit before tax. I mean, almost 106 crores. This is the first time that our EBITDA as well as our profit before tax has been over 100 crores. So there is a lot of strong momentum in the performance of our company, both on the top line growth as well as on the bottom line growth.
I know, just to complete the top line point, we'll come to margins and EBITDA in just a bit, but steady state basis, because you've recently done a lot of acquisitions, steady state top line growth on a CAGR basis, let's say the next 1 to 2 years, do you think you can do better than 20%, which is what you've spoken of in the past? But what should investors work with?
See, the best way to look at the future is to take, lessons from the past. Now, it's been 5 years since we completed our IPO in August 2019 to now, and we have grown our revenue substantially in this time. I mean, more than 6 times or 5 to 6 times in terms of top line growth, profitability growth. So if you look at our past track record, it clearly shows that we've exceeded all pre-IPO expectations of our stakeholders. And even forward 5 years, my outlook on our industry is very strong. I think there is enough basis to say that Affle should be modeled at 20% CAGR growth for the next several years, because we are in a high growth industry. I mean, we are in emerging markets like India, global emerging markets, even in developed markets. Our focus on emerging verticals, gaming and other verticals is actually providing us the foundations for consistent, long-term, sustainable, high growth. And the outlook is very optimistic, and it's backed by the track record of the last 5 years.
Anuj, so for FY25, can we expect like a 25% top line growth? And what about margins? Should we expect close to 18% full year?
We don't provide short-term guidances, but what I can tell you is that as a CAGR basis forward many years to come, modeling our company at a 20% top line growth and margin expansion leading to, from a bottom line perspective, achieving 20 to 25% growth on a year-on-year basis from a bottom line profit perspective should be quite very much on the cards. Yeah.
Okay. Hi, Anuj. I take that point from the time of listing. You all came in that niche space, and in fact, it's been a multi-bagger. So kudos to you as well as the management on that front. But I want to get back to the margin parameter, because I recall between 2019 and 2021, you had margins, I think, of closer to around 25%. Then you did a lot of acquisitions with diluted margins a little bit. How soon before we get to the 25% margin mark yet again? Or are you satisfied in the early 20s?
I think looking for quality revenue, which is, delivering profitability and cash flow, is a fundamental DNA of our company. And therefore, even the acquired companies, the consistent effort has been to integrate. We have, in fact, in this quarter, achieved full consolidation, full integration as a single cash generating unit. All the leadership team of 20 CEOs and VPs are, providing hands-on leadership. So growing margin is a single-minded focus of the organization, and we are very, very clear that our margin or bottom line growth will exceed top line growth. So when I say model our company at 20% top line growth, I'm also in the same breath saying model our company at 20 to 25% bottom line growth, which means we will see margin expansion. Now, typically we would take a 3 years view to our business, 3 to 5 years plan for our business, and we should get there, and we are consistently working to get there. When will we get there exactly? I will hold this back. Let the numbers talk.
Okay, Anuj, for the time being, the numbers are talking. The street is satisfied with what you've been delivering. The next 5 years as well will be crucial. Appreciate you joining in this morning and giving us a gist about what went on in the past quarter and how you see the company shaping up going ahead. For the time being, though, we'll slip into a short break. You come back, we'll get technical focus. Shilpa as well as Sudarshan, they'll be waiting for us to give us their technical analysis. Don't go anywhere. Welcome back. Well, let's focus on the technicals of the market. Shilpa Rott of Prabhudas Lilladhara joins us on the show. Hi, Shilpa. Good morning and good to see you. Well, we have done some fundamental analysis, but we want to hear from you. How are the technicals of the market shaping up? The FIs are still long. The clients, they've covered some short positioning. The 20-day MA, I'm guessing, is very crucial. How would you approach trade, given that we start off with a cut of around 300 points?
Good morning, Nigel and everyone. And thank you for having me on the show. Talking about the placement, yes, indices look like they will face some immediate resistance. Talking about Nifty, we see that 24,800 is actually looking a very strong resistance. The call writers are very aggressive out there. And the interesting thing is that the put writers, they've shifted their positions way downside towards 23,500 as well. So definitely the risk reward now goes in favor for the bears, wherein you can go for a sell from here, keep 24,800 as a stop loss and look for targets of 24,000 to 23,500. The FI's net long also now at roughly 64%. They have dropped significantly down from 80s to 64. From here, they can also cover their longs and go to 45% from here. So in that case, 23,700 to 23,500 are levels which you cannot rule out. In the same case, Bank Nifty, we see that the option chain is looking quite aggressively, where the call writers at 51,500s are very aggressive, and that can be a resistance on immediate basis. And on the downside, the immediate levels to look out for would be 50,000. So definitely a cautious approach now with resistance placing up immediately.
Okay, so you won't be buying the dip is what you're telling us. You believe that maybe, in fact, being a little bit cautious is something that you're looking forward to. Got it. Shilpa, what about individual stocks? What are you tracking?
I have one sell and one buy. The buy would be IEX. IEX, after a very long consolidation, now it has not sustained above 190, 195 zones. So as long as we are here, we can see that the level can move upwards towards 205 to 210. So even on declines today, since there could be a gap down, so buying around 190 levels, I guess, will be a very attractive levels where you can keep a stop loss of 186 and look for targets of 205 to 210. The other one would be a sell in SBI cards. SBI cards now likely to open below 700, which will only trigger more weakness for the stock. And as long as it stays below 700, I guess, the stock can do 680 to 660. So this is a conditional sell. It has to sustain below 700 for a sell.
Got that. Shilpa, thanks very much for that. Sudarshan is also with us with what he's making of things. Sudarshan, good morning. Good to have you here. Will we see a repeat performance of the strength and resilience here, or and what's the advice really?
Yeah, good morning. I don't think we are going to see strength and resilience today. I think you well understand the world markets are not in the mood to give us that strength. And in any case, the Nifty is correcting. It's not going into a bear market. We have gone to 25,000. It's only fair that the markets will pause, consolidate, correct, and then give us another buy on dips opportunity at some point of time. So for today, there is no buying idea in the Nifty, and the markets can do anything. They can suddenly start going up, but I would not expect to be a buyer today. Intraday shorting in the Nifty is always very difficult, so stay away from the index, focus on individual stocks.
Let's get to that then, Sudarshan. Tell us, what are the individual stocks you're tracking?
Sure. See, M&M Financial is my only buy idea. Buy with a stop under 289. Now the stops will have to be adjusted depending on how it opens, but it's a positional trade. It's worth looking at. ACC is an intraday short with a stop above 2,500. Coforge is another intraday short. I'm looking at stocks that were weak even during the previous rally. So they're probably going to get weaker. Coforge is an intraday short with a stop above 6,200. And finally, Persistent Systems is another intraday short with stop above 47.50. Try to avoid the market as much as possible.
Okay, all right. Sudarshan, thank you very much. Shilpa, appreciate you joining in with with those trades as well. We'll take a quick commercial break here. We are back. We have the pre-open with us. We'll also be joined by the country's largest bank, Dinesh Khara, Chairman, State Bank of India, on first quarter earnings and outlook. Stay tuned. Okay, welcome back. I think the pre-open session is going to come up in just a bit, in about a minute or so, and we'll have the first rates about what it looks like. It's a negative start if you're just joining us. Global markets are panicking a little bit, and the main reason is that many are fearing not a soft landing, which is a very sort of nice, gentle way to, as the economy slows, but a recession, which is more uncontrolled, which is more sort of difficult for corporates, for the economy, etc. And as a consequence of that, markets, of course, around the world have started to price in much higher odds of rate cuts coming through. So markets are expecting about 125 basis points worth of rate cuts in 2024 from the US Fed. That's essentially the pre-open. Is that the first pre-open rates are on your screen? We are starting about. It's indicative of a 4% cut, but 4.5% cut. But, things will settle. Things should settle down a little bit. And this is, of course, the first cut reaction. Pre-open continues till about 907, 908. And then we go into the market opening at 915. Those are the first pre-open rates which are coming through at this stage. Bulk of Asia, of course, is also trading in the red. Japan, Taiwan, South Korea, etc. There is, of course, also at the margin, the impact of NVIDIA. The news came about 3-4 hours back that most likely NVIDIA is going to delay the release of its newest AI chip, which is called Blackwell, by 3 months. But, it's all about incremental news flow, and that is negative for markets as well. NVIDIA has had such an outsized role for global markets, US equities in particular, but also markets like Taiwan, etc. More on sort of, these rates and we'll keep putting out more information. 700 points lower, settling down a little bit, as I said. Give it a couple of minutes more, and we'll get a real sense. Prakash, of course, is still with us. Prakash, so, you know, on a day like today, just sort of stay on the sidelines, watch the action. And if you're leveraged, then reduce leverage. I mean, should be reducing leverage coming into this week, but if not, do it. What else, Prakash? What else should one do?
So, more importantly, Prashant, you know, given where the market is, I think very soon you'll also start having traders struggle with margins. We've got a very rapidly reducing margin profile of a lot of stocks that the exchanges have already announced. So we've seen that cut happen, go to 50%, and probably go to 25%. Now, eligible stocks on the margin trading facilities are actually going to precipitate some of this sell-off. So we've not seen DI's sell-off as yet, but you'll probably have the retail segment adding to this fall. I would definitely love to wait for this cool-off to happen. I mean, we've been waiting for this for quite some time, right? I mean, it never came about, but once it does, it'll probably be very precipitous, is my guess. So the next couple of months, if not just a few weeks, could be the time to look for value. But given the way there's so much of capital expenditure happening, whether it's, you know, Adani setting up a new cement unit in Bihar, the new high-speed corridor getting announced, you'll probably start having incremental news flow, which is positive, but right now will get ignored and start getting acted upon probably a few weeks from now. So yes, absolutely, you're right. Wait on the sidelines, but be ready with what you want to buy, given the domestic salience, and don't get too worried or panicked about this. But the sectors that look like still, you know, promising enough in this fall would probably be pharma, would probably be a lot of FMCG and some infrastructure names. So that's the pocket that we are very, very keenly watching for.
Okay, by the way, just want to point out some stocks. LIC Housing, of course, anyway, Vamakshi was telling us the numbers are looking really weak, that margin compression is crunching. Watch out for Samvardhana Motherson. This news, as far as I remember, I think came after market on Friday. Now, they are buying 34% in Motherson Auto. Some sort of a, you know, group-related transaction, but the stock was under a lot of pressure. Now it's cooled off. I mean, that first cut was about 9-10% lower. Now it's about 3% lower. So let's see how that plays out. Overall on the market, now it's about a 600-point drop. That's how it's playing out. Okay, so Prakash, is going on the basis of results in the last couple of days, anything that specifically stands out for you? I'm just checking delivery as well, because delivery's numbers are very good. Stock's a little flat right now. Anything that you'll buy purely going on blockbuster Q1 numbers?
I think, except for Zomato, there was nothing in terms of numbers giving you some sort of a confidence that things could continue looking positive. Yes, delivery, of course, we've seen it turn around for the last 4 quarters very distinctly. But I would believe there will be a lot of opportunities, not just on the basis of numbers. You know, even the nifty numbers, whatever we've tracked, about 39, 40 stocks that have come up with numbers, the results haven't been too bad, Surbhi. So we still have our estimates at about 1130 on the FY25 EPS, this thing. So from that perspective, nothing much has changed. What's going to change is the PE expansion that we saw, which was so rampant. So I would still wait for the earnings season to completely come to a draw and then probably look at things. But as I said, pharma, you know, Divi's Lab, we probably didn't get to speak about it, but the numbers were pretty good. The commentary is so good. It's just that expectations were too high. So I would look at pharma, some of the FMCG names making a significant comeback, and you know, some of the agri-focused names like Godrej Agrovet and all of those. You know, so these are very specific bottom-up selections, but you'll actually be spoiled for choice if the Nifty comes down about 500, 700 points in the next few days, and that's the time to kind of start cherry picking.
All right, Prakash, that's a good point, right? 39 Nifty companies have reported their numbers, which is more than 80% of the weightage as well as the total profitability, and it appears it's quite good. My only worry is in the mid-cap index, because there the index itself is trading at a sharp premium in comparison to the Nifty. So let's see how it goes. Appreciate you joining in, Prakash, and filling us in with all that analysis on a whole host of stocks. Let's focus on SBI. They reported their first quarter numbers of the weekend. The bank's profit as well as net interest income came a little bit below than estimates. My colleague Ritu caught up with Mr. Dinesh Kara, the chairman of SBI, and began by asking him about the deposits as well as the outlook for credit and deposit growth going forward. Let's hear out what he had to say.
When it comes to deposit growth, it has to be seen at what cost what interest rate are we raising the deposit. And, you know, as a banker, we have to strike balance among various conflicting demands. And that is one of the reasons we have to be very mindful in terms of where our NIMs are. You would observe that our cost of deposit has gone up by about 45 basis points. But when it comes to NIM, it has only dropped by about 11 basis points. So that's very clear reflection that we have been very conscious in terms of the cost of deposits. And that is the reason why the absolute number of growth may not sound to be as big, but at the same time we have got some excess SLR, which is to the tune of about 3.7 trillion even today, and that is something which is helping us in terms of supporting our loan book growth, which is at 15.5%. So as of now we don't see any challenge, and we should be in a position to navigate these situations also well, without any impact on the our NIMs.
So speaking of NIMs for the quarter at 3.2% on the whole bank level, 3.35 on a domestic level, they have come down. Do you see further pressure on margins from here on, or will the bank be able to defend NIM at these levels?
I hope that we should be in a position, because whatever increase in deposit rates have also happened, even our MCLRs have also gone up of late, and we will be in a position to have the better yield on advances. Our yield on advances have already moved to about 8.86%, and we should be in a position to improve our yield on advances going forward. So that is something which will help us in ensuring that our NIM, we should be in a position to protect around these levels.
Okay, and sir, in terms of your credit growth outlook, you know, earlier when we'd spoken, you'd spoken about a near 15% kind of growth for the year. What is the current loan pipeline looking like across segment, and what do you think you can end FY25 with?
We are having a pipeline is about 4.76 trillion, and it is equally split between proposals in pipeline and also proposals which have been sanctioned but awaiting disbursement. So I expect that, of course, you know, when it comes to these corporate proposals, the disbursement takes some time. It does not happen immediately. But yes, of course, a significant portion of that, at least part of it, will be availed. This is what we expect. So I think I expect that we should be in a position to maintain our earlier guidance of about 14 to 16% kind of a growth, and more towards 15% kind of a growth is something which we expect to deliver in this year.
Okay, 14 to 16% credit growth level. Let's move on to the asset quality, where, you know, of course, the ratio has been stable, but fresh slippages have risen significantly to about 7,900 crores. SMA book has also gone up sequentially. How much of this do you attribute to seasonality? Where did these fresh slippages come from? And, you know, what sort of improvement do you see going ahead from these levels? You know, for the full year, for instance, what could the slippages and credit costs look like?
See, as far as slippages are concerned, about 7,900 crore worth of slippages which are seen in the first quarter. Out of this, more than 1,600 crore have already been pulled back. That is one. The second aspect is that invariably in the first quarter, it's very unusual trend, because we start the quarter, we start the financial year all afresh, and we don't have the benefit of the previous recoveries which have taken place. So I think that is one of the reasons why first quarter always get to see some kind of a higher slippages. So I think I don't really envisage any challenge. And the other part is that we have seen some kind of a, loan growth is quite handsome, and we need to provide for the aging provision also for the standard assets. So that is other reasons why we get to see the higher provisioning numbers. But as far as the asset quality is concerned, our SMA book is now seeing a gross NPA number of around 3.5. Agri is also somewhere in the range of about 9. And when it comes to corporate, it is just about 2.2. These are all gross NPA numbers. So, and when it comes to retail also, we did see some kind of a uptick, and when it comes to the unsecured retail, but that was essentially on account of some delayed salary credit in some of the salary package accounts, and that is the reason why we had seen this kind of a slippage. But this all got taken care of in the month of July, and that is something that has helped us in pulling back some of these, I think majority of these accounts. So I think we don't envisage any major challenge as well, and any challenge for that matter as far as the asset quality is concerned.
Okay, so that was Mr. Kara outlining the trajectory ahead for State Bank of India. Let's quickly move on and get in our 9-10 calls as well. The markets sort of, in the initial blow was crunching over 3.5% down. Now it's like settling to an open, which could be about 400 points lower. Let's go across to our experts for some calls. Sudarshan, what would you go with?
Well, I would go with Coforge. Consider an intraday short in Coforge with an initial stop above 6,200.
Okay. 62 under 6,200. Shilpa, your trades? Okay, I think we'll have Shilpa join us a little later. Sudarshan, thank you very much for that. 400 points lower, by the way, with 3 minutes to go for market open. That's the pre-open where things have settled. But let's focus on individual names. UPL reported numbers during market hours on Friday. But Sonal is here to tell us more. Sonal.
Well, yes. So they held the con call after the numbers. It reported a net loss this time around after reporting profit in Q4. Brokerages, they are quite bullish on the valuations and the fact that volume saw growth this time around, though pricing was lower. Jefferies is a buy call with a target price of 665 rupees a share. They say company reported a net loss. However, the volume growth was healthy at 16% on a YY basis. It was offset by a sharp price decline. The management has retained the FY25 outlook, but Jefferies has gone ahead, cut the EPS for next 2 financial years by 2%, while FY25 cut is sharper. HSBC says that yes, first quarter was a miss, but strong volume growth is a sign that there is stability in, it's a positive sign. From here on, there could be stability in prices as well, and inventory rebalancing, which is key to recovery. Rights issue and other initiatives that the company is taking for debt reduction is a key positive as well. Investec, however, still has a sell call with a target price of 385. Management indicated that pricing recovery is underway, or price decline has sharply arrested, and they do not expect any further decline from current levels, but valuations at 17 times 1 year forward earnings, which is the cheapest in the agrochemical space, is something that they like about the stock.
All right, Sonal, thanks very much. So UPL in focus as well. Back to Mangalam. Let's just revise Britannia and how the earnings look. Mangalam?
Well, Britannia, top line was no problem. In fact, it was a tad better than street expectations, 4250 crores on the revenue front. Volume growth at around 8%, again, the higher end of expected range. And more importantly, the management, speaking highly about the possibility of recovery in rural and them benefiting the most from it. However, a couple of brokerages not particularly happy with the gross margins out there. Macquarie has said that the gross margin surprised negatively, moderating 150 basis points sequentially. They have a target of 4,700 on the stock. Morgan Stanley too says that, the gross margins at 41.8% were lower than their estimates of around 43%. The management did call out caution around the commodity prices, but more clarity, I believe, we'll get at the earnings call, which starts at 10. Top line, no problems for Britannia. In fact, the revenue growth came in at 4% because of the price cuts that the company had taken. But that has resulted in volume boost, and that is something we'll watch out for as the year progresses.
Okay, all right. We got a couple of seconds to go. Mangalam, thank you for that, for the pre-open session, and we'll kick off things right there. I mean, I just want to say one thing. If you are new to the markets and, you've made a lot of money, it's been absolutely a fantastic ride, but corrections are part of the journey. And I think one should absolutely be ready for pullbacks, from time to time. The only sort of surprising thing is that we've not had those pullbacks along the way over the last couple of years of any serious degree. So, part of the game, really. We got the first trades coming up, 400 points lower, 24,300 is where we are at on the Nifty. We've got 1.6% in terms of a cut. So this is par for the course, given the weakness that we are seeing across in global markets. I mean, I think with a 1.5% cut, you're still kind of outperforming what the rest of the world is doing in many respects. We've got the bank Nifty, which I think is also starting, of course, lower. About 1% down, 1.25% down. Nifty Bank, by the way, ended the week higher. Nifty ended the week lower. I'm talking about the last week. You've got the mid-cap and small-cap indices, which will come up next. Market breadth, of course, is negative, deep in the red, and that is also to be expected. Nifty IT index is down about 2% or so as we begin this particular trading session. So a lot happening. There will be individual stock level reactions, and I think it'll be easier to count what is up rather than what is down, since it's a broad down day because of what's happening on the global screen. So 24,325 is what the start looks like. And, we've the lowest point today, gap down, is 24,297, just under the 24,300 level. Remember the budget day low, of course, far below where we are at this point in time. That was 24,074. You're a full 200 points, 220 odd points above that particular number.
Okay, just coming to individual stocks, the sell-off in the auto segment, that is continuing. That was sort of a trend from last week. Maruti is still down about 4%. Hindalco, Nigel alerted us. I think Kotak's gone a little bearish on the stock. It's under pressure. Anyway, there's a global onslaught that's in the works as well. Tata Steel is lower. Titan, there is no sheen after the numbers coming through. Plus, of course, the stock has drawn up so much after the budget as well with the customs duty cut on gold. SBI down to 2.5%. That's the result reaction that we're getting. L&T, Reliance, a lot of the heavyweights are fighting hard. And some of them are already coming off the lows. So let's see. On the upside of the screen, not much. Sun Pharma is about 0.5% higher. Britannia is just at the surface with a cut of about 0.2% at this point in time. But in general, your names on the pharma side, Dr. Reddy's, Divi's, etc., they are not falling as much as the rest of the market. Pretty expected. That's what we have going. Just very quickly on some of the sharp result reactions to talk about, what really stands out. I think it's probably LIC Housing Finance. 5.5% lower. By the way, some of the sugar companies reported really weak numbers, Renuka and even Dalmia Bharat. So the sugar stocks also on the weaker side.
Well, one stock that's notably standing out in the green is UPL. The markets are down, but that one's managing to hold on to some green as we speak, so keep an eye out on that one. But a few of them from the broader markets are getting clonked. Nuclear Software, I'm not sure what's gone on there, but that stock is down more than 10% as we speak. So sharp downtick is what we're seeing on Nuclear Software. RCN Chemicals as well, that's another one that's down nearly around 7%. So some of these chemical names are suddenly taking it on the chin. Sudarshan Chemicals as well is lower. One of those other big outperformers of the last few years is Uno Minda, and that stock as well starts up on the back foot. So keep an eye out on that one as well. A few more notable movers. You have Bharat Forge that's down because of the truck sales data that did come in earlier as well as the risk off that we're seeing. BEL as well is under some pressure, so that stock as well is sitting with a bit of a cut. And some of these railway-related stocks that actually had a big run, they are coming for profit taking. RVNL, IRFC, all of them under some pressure. Even IRDA, that stock now has seen close to under 20% correction from the recent peak, though it's much higher in comparison to its IPO price. A few stocks, though, that are on the green. Marico is holding up with a gain of close to 100%. I think the crucial number to track from here on will be the advanced decline ratio. As of now, you only have 110 stocks that are advancing in comparison to more than 2,000 stocks that are declining. So keep an eye out on that one as well. And, Hormuz just tells me that the Nifty is still above the budget day low, but the Sensex has breached that, which was 79,224. So the Sensex, in fact, has breached the budget day low. As we speak, it's pulled back a little bit from there.
Absolutely. And, so 400 points lower is what you have on the Nifty at this stage. We are at about just under 24,300 at this point in time. Just a few other outperformers, right? It's all relative out there. Look at Britannia, if you can just have these names up. It's up 0.25%. Sun Pharma is up about 0.75%. BPCL is down just 0.5%. That also counts as outperformance on a day like today. On your screen, these names, Britannia, Sun, BPCL. HPCL is also just flat, nothing at all, 388. Remember, oil is also sold off 3%. Brent oil prices are down 3%. So that is a relief. Apollo Hospitals is barely down 0.33%. So keep an eye out on some of these names because they're not down a lot as the market starts to stabilize a little bit. Maybe there'll be opportunities here. Kotak Bank is down 0.75%. Lever, I'm seeing a lot of FMCG. HUL is up 0.4%. Shakti Pumps is up 3.5%. So 4,800 plus on Shakti Pumps, large volumes. Nestle is down just 0.33%. So yeah, clear sort of FMCG tilt here. Marico is up 1%. And Marico should also come up. So 669, 670. And there is Dr. Reddy's, which is down just about 0.4%. So this is the part of the market which is outperforming on significant volumes in terms of what the rest of the market is doing. Otherwise, of course, I'm not going into a long list of losers here, but it is a long list, but not volume backed, I have to say. Right out of the gates, this is not a big volume-led sell-off. I'm looking at the broader market list of stocks. There are about, what, 7, 8 names with decent-sized volumes. That's about it. Phoenix Limited, the mall operator, that is down 10%. I think, again, on the back of earnings, 31.35 on Phoenix at this stage. So more on this as we go along. But we are now, we've broken the opening lows for the Nifty. We're down about 450 points, 24,278. Tahir Badshah is Chief Investment Officer at Invesco Mutual Fund. Tahir, good to have you with us here. Thanks for your time. I remember, and I was sort of saying this on Friday, we had Naren with us from ICICI Pru, who was on a week and a half back. It was right out of the budget. And he was saying that, there's got to be, in a normal market, there's got to be more up and down, more volatility, really. And I think, of course, lamenting about the fact that money is coming in and you've got to deploy, but markets are what they are. So it's kind of tough. How do you see this reaction and what we're seeing globally? Markets will do their own thing, but I want your thoughts on this, on what's going on in the US. What's your team and what's the global view, Tahir? Are we likely to see a US profits recession? Go on.
So Prashant, we've seen a plethora of events shape up over the last few days, and it's obviously difficult to make sense of everything and put the pieces together. There will be, there are different factors which have been affecting different regions, whether you take Japan or US or maybe even emerging markets for that matter. I think as far as the US is concerned, what we read and what we probably still share as a view and probably is a continuation of what we, in a way, expecting that, we will probably try and see some correction as far as the inflation dynamics out there are concerned, and some bit of slowing of growth as well. It is still not very clear at this stage as to how much is a slowdown out there. We've seen the initial reports only from a job perspective, and we have to still probably await data at a ground level, and that probably will come about in the next some time. But in the meanwhile, I think what is happening is quite unexpected lines in a way. I would say that because there was this expectation that in the second half of the year, we will probably try and finally see some possibility of rate cuts emerging. And if the labor market was something which was coming in the way over and above inflation, which had kind of settled down, then I would like to think that there's a positive development. It may probably finally, move the Fed out of its long, pause. And, we can then finally look forward to those rate cuts, which have been eluding us for some time. So it's still not entirely clear as to what is the extent of the slowdown as yet. There is an anticipation of the market as reflected from the 10-year out there that the slowdown is very significant, but may not necessarily be the case. We've seen very sharp, decline in the treasury yields out there, as we know. So we'll wait and watch, but I think at some level it is not entirely doomsday, I would think, as far as the US is concerned.
Tahir, hi. Good morning. Let's talk about India. By the way, I was checking, NASDAQ futures are again down almost 500 points. So the fear factor is really working its way through the futures market, at least the traders that are active right now. Even Dow futures are down about 300. So let's see when we see the end of it. Tahir, morning. So the thing is, Prashant was talking about one-way moves, right? And the narrative that has been drilled into investors here in India is that you must buy every dip, and they've been following that to the T, right? It's a one-way market. Every dip is bought in. Investors only know that they need to pump in money whenever the market falls, which is fine. No one seems to be talking about profit-taking. No one seems to be talking about the other end of the spectrum. Your thoughts here, given the elevated levels of the market, the fantastic rally that we've had, is profit booking advised in any parts of the market?
So we have been taking this view that since a fairly long period of time, while we did in the last conversation mentioned that we've taken some heart in the earnings delivery up until now, and generally corporate earnings in India still being reasonably stable. But obviously we are expecting a fair bit of volatility in the second half, driven by many events. Some of these events which have happened in the last few days are not necessarily what we entirely anticipated, but we were expecting that there would be possibility of volatility coming through in the second half of the year, and that may crimp returns compared to what we have been used to in the past. So yes, you're right that we do not necessarily expect the second half to be as smooth as what the market behavior has been, especially in India in the last 6 to 9 months' time. And I think some of the other events are yet pending, whether it be in the form of outcome of US elections, as well as in terms of the direction of interest rates. But I think there are, from the events of what has happened in the last some days, there's some positives as well. So we like as I said, that we do now see a possibility of interest rates both in the US as well as following through in India, cut in interest rates coming through. And the second being that fortunately, despite the fact that there is a war-like background once again in the Middle East, we've seen commodity prices, particularly oil, behave reasonably well, in fact, favorably. So again, a departure from what we typically see when there is geopolitical risks. But this is something which probably will come to India's defense. But in the meanwhile, yes, we'll see volatility. We'll probably see churn in the market. We'll see rotation as well for whatever duration of time from, let's say, certain aggressives to certain defensives. So all that is what we probably expect and to unfold in the next up until the end of this calendar year. And to some extent, we've tried to prepare ourselves in terms of our portfolio positionings to, defend ourselves.
You mentioned rate cuts. Just to complete that point, in the US and in India, you're expecting, how much of a rate cut in India in this calendar year?
So, well, we've not put a number to it, but essentially, I wouldn't be surprised that we start off with at least a 20, 25 basis points, and probably in the next 6 months' time, we get to a 50-odd basis points if, the US particularly commences on its rate cycle.
Hi, Tahir. Good morning. So it appears the risks are global in nature. US recession, the reversal of the yen carry trade, as well as geopolitical issues, they're back on the table. And given that sort of environment, which is the place to hide here in the Indian markets? The FMCG stocks, for the time being at least, they're doing relatively better. The Nifty is down 500 points. You have green on HUL, Britannia, Marico, they're doing pretty well. What's your view on the FMCG pack?
So once again, Nigel, we spoke about that as well some conversations ago, and exactly that there will be some of these sectors which will probably make a comeback for one reason or the other, and there is a confluence of factors which have started to fall in line, stars aligning, so to speak. One is that we've got a good monsoon. We've already had a fair bit of deep cyclicality as far as the sector is concerned. Many parts of the FMCG stroke, consumer durables stroke, value retail, if I were to call it, or consumption at the lower end of the market in general. Those are parts which have actually lagged the overall market in the last almost 24 odd months. So clearly a catch up. There are certain factors, interest rates coming along the way. That has also been a factor which affects these pockets of the market a little more than what it does to the others. So the reversal of interest rates probably should also kind of act as a support. So I think. And last but not the least, I think obviously the market is not significantly exposed out there in terms of ownership levels, at least incremental ownership in the recent past. So I think these all should drive up valuations out there. Certain expectations will develop out there. Maybe they will overshoot as well in the short run. So that's kind of likely. And that's like where I said that, sector rotation away from certain risk assets, away from probably parts of value to growth parts of the market is quite likely.
Just coming back to you, Tahir, I want to highlight a few more names as we are moving on, as we're seeing. Just a few sort of stocks, really. You've got Senco, it will come up on your screen. That's up 1%. There is, of course, all these FMCG stocks are higher. Marico, HUL, Pharma, Sun Pharma is high. UPL still trades in the green. There is Lux Industries out of the blue. Coming up as one of the top traded names, but it's up 1.5% at this point in time. Kernex is flattish. Samhi is up about 1.33%. So it's a mix, but market breadth is of course overwhelmingly lower at this point in time. I think some 20 stocks lower as compared to 20 to 1 in favor of declines at this point in time. Lots of 5-6% cuts. The railway stocks are all down. Mazgaon is down 6% or so. There is NBCC, which is down 7%. IFCI, Ircon, Railtel. These are all names which are down between 5, 6, 7%. And of course, so much more. So 500 points down now. We're at about 24,200. Now 24,200 is to my mind a decent kind of support level. Market spent a fair bit of time around these levels. So let's see if we are able to hold this. Otherwise, you're essentially then looking at the lows of the day in the budget, which is about 24,074 or so, 24,100 roughly. But we'll see if the 24,200 comes into play, and then by close we are able to hold on to it or not. Tahir, What else would you do at this point in time, and what would you ask your team to focus on at this stage?
So, we've not really changed any major tack in terms of our approach to the markets. We continue to ideate. We continue to look at various parts of the market. In some of the value parts, which have done exceedingly well as well. Some of these corrections are welcome. Probably they will give us some better entry points. Look, like as I said, I mean, we do expect that the markets will moderate. There will be certain return expectations that we need to recalibrate. We need to be somewhat more conscious about risk over return. All that said, I mean, we don't expect very deep corrections or deep cuts in the market, because we generally believe that when we look at the overall economic scenario and the health, it's not something which is very daunting. There will be some of these global circumstances which will create disturbances once in a while. But I think if we are not expecting deep corrections in the first place, so if we get something which is of that 5-7% variety, which is what it should turn out to be in my view, I think in that process, if we get certain interesting opportunities across a swath of sectors, we are prepared for it. But in the meanwhile, need to be more balanced in terms of the overall portfolio configuration, at least to make sure that we don't get, we prepare for risks more than return. And I think to that extent, rebalancing the portfolio has been undertaken in the recent past. We'll try and continue to explore those possibilities, whether it be sectors like FMCG or consumption, lower end consumption, maybe IT also to some extent. Perhaps banks, they too might become interesting at some stage. So I think this is how we will probably approach it. Bottom line is basically just try and keep as much diversity as possible. Positive framework, but use corrections as opportunities to buy what you would have loved to buy at better price points.
Okay. All right. Tahir, thank you very much for all the perspective. Much appreciated. You have a good day, and we look forward to the next call. All right. The market is still nursing those losses, 470 down. So as of now, that dip isn't getting bought into. Let's see how this plays out. About 2% decline. But compared to the rest of the Asian screens, this is probably not too bad. Let's move on then and focus on Narayana Health. The company's revenue and margins came in line with street estimates for the first quarter. The margin is above 20%. For 8 consecutive quarters now. To talk about the performance and the way forward, we have Sandhya J, Group CFO of Narayana Health. Sandhya, thanks so much for joining in. I'm just looking at the numbers, as we kickstart the conversation, and it's been a pretty good quarter, because I think your revenue, both for inpatient and outpatient, it's shown a decent improvement. Can you just tell us what the occupancies are like? Though I know you always make that point that now, people have to spend lesser time in the hospital because of the advancement in technology. But just to get an idea of, average occupancies and the average revenue per patient.
Sure. Good morning. Thank you for having me here. So from a Q1 point of view, I think both from a revenue point of view and from a margin point of view, we've seen, I think, a good expansion. From average revenue per patient, that's measured in IP and OP. So our IP ARPP is about 1.29 lakh. That for the same quarter last year was 1.18. So there is an expansion there. And OP ARPP, which was about 4,089, is now 4,400 odd. So there is expansion on both of them. As far as occupancy is concerned, like we've always said, it's not a very accurate measure. We always aspire to be on an occupancy range of between 60 to 65%, which is the midnight occupancy, which then is a much higher occupancy in the daytime because of the daycare, which you explained. So this being a little bit of a weaker quarter for healthcare, we've come more on the lower end of that range for this quarter.
So that would be closer to 50% occupancy?
60 to 65 I mentioned, so we'll be in the 60% range.
Okay. And what about, the trend from here on? And if you could also give us some sense on the more evolved, the higher level surgeries, what has been the pickup on that side of the business?
Yeah, so in Q1, we've seen a lot of high-end procedures coming through, both because of the awareness which is being created in terms of high-end procedures, but also in terms of the convenience of patients. What we've consciously done is made significant investments in the current year in terms of our own robotic program. So therefore, we have robots coming up across our hospitals on top of what we already have. In addition, we've also continued to strengthen our transplant programs as well as our orthopedics programs. So therefore, we will continue to see an upward trajectory on all the high-end work that we are currently doing.
All right. Hi, Sandhya. Good morning and good to see you. Just to understand, as a percentage of the total mix, what is it at high-end surgeries as a percentage of your mix? If you could give us that number, what was it? What is it? Where do you see it headed?
Sure. I'm not sure if you've put that number out there because there is no clear industry definition on high-end surgery. But what we will do is probably work on this a bit and then come back with a little more industry-aligned approach, because we may have an internal measure, but we would want to share something that's more comparable with the industry. So maybe, when we speak next time, we'll come with a better measure on high-end surgeries. I think it's a good call-out to have.
I got that. Sandhya, hi, good morning. Prashant here. Could you give us a quick sense of the sort of capacity expansion plans afoot at the company, and how many beds by the end of the year, and just give us an overall sense.
Sure. So as you're aware, we've been on a little bit of an intense capex drive over the past few years. We've done 1,000 crores each of capex the past 2 years, but a big chunk of that was in Cayman. Now, Cayman expansion is completely done, so all the money is pivoting into India. This year, we've guided between 1,600, 1,700 crores of capex, and I think we will be in a similar range for the next few years. Having said that, we will not be creating any significant bed addition in the next 2 to 3 years till our capacities come up, because all our projects are greenfield at the moment. We are building capacity because we believe that that is the most effective way of return on capital in this, because it's a very asset-heavy industry. So therefore, you will see a lot of capex intensity over the next few years, but the inflection point or the return on those capex intensity, either in terms of number of beds or in terms of revenue growth, will come a few years down the line.
Sandhya, will that capex intensity be all organic ground-up growth, or are you looking at inorganic assets as well? Because there's a lot of consolidation going on in the industry. There's so much chatter around, for instance, Aster DM, etc. So just want to get your thoughts on it.
Largely, we are looking at organic growth. We looked at inorganic opportunistically, but because ours is a model where we want to be cost-effective to our patients as well, therefore, we are not going after assets which are very high priced. So therefore, we will be finding that balance. If we find the right cultural fit, right price fit, we will be interested in those assets. But the way we've looked at this market so far, I think we've been more indexing on own build. That seems to be fitting into our parameters better.
Can you just give a geographic breakup in terms of the rollout as the capex comes on stream and more beds get added? Will it be sort of more skewed towards the west, south, north? I mean, just some idea of geographically where Narayana will be, say, a year down the line when this capex comes on stream.
So the capex will come on stream over a few years, because building a hospital takes 2 to 4 years, depending on the size of the hospital you are building. But in terms of priority, it is Bangalore and Kolkata. So a large part of our capex will go into Bangalore and Kolkata. We are keeping aside some amount of capex for our other regions where we already have presence. But those we are taking up after we've exhausted the opportunity set here in our core market, which is where our ROCE is highest, and also our return in terms of revenue and margin performance is healthy. So we are allocating more capital into the healthier part of the business to start with.
All right, Sandhya, we'll leave it there. Thank you very much for your time. Appreciate you sort of coming on and providing that outlook for us. Well, let's bring in our next management. Titan is with us. The management is with us. First quarter was a bit muted. EBITDA profit met street estimates. Gross and EBITDA margins were stable as well, though. We have Ashok Sonthalia, CFO at Titan, now joining in to talk more about the first quarter performance. Mr. Sonthalia, good morning. Great to have you with us here as always. Prashant this side. I guess what the market wants to know is the outlook for the remainder of FY25 for the jewelry business. Could you tell us how has the second quarter panned out so far?
So, in fact, the July month had a major event in between in terms of union budget, reducing custom duty in a large this thing. So pre that, market was okay, slightly better than I would say Q1. But post custom duty reduction, we see a lot of traction coming in for particularly gold jewelry. And a lot of customers are coming in if they were on the fence to make their purchases. That gives us the encouraging sign for the remainder of the Q2 and Q3 being a festive quarter always. We are very, very positive about that.
Could you tell us, post that sort of customs duty change, what has been the is there a noticeable bump up in sales?
In the gold jewelry purchase, I can say, yeah, it is a noticeable.
I mean, would you be able to broadly, ballpark quantify it?
So if the Q1 growth numbers were 9% above, definitely we are seeing healthy double-digit growth post budget.
And sir, is this only restricted to jewelry, or are you seeing sale of coins as well? I mean, because that duty, the capital gains tax cut, that's the other bonanza, right? Coming down to 12.5%. So just wondering if there's more investor appetite that's already visible?
So custom duty has a direct impact on jewelry business, particularly gold jewelry business. And we have talked about that. This is very, very positive move by the government, which will help jewelry industry to be more organized and and it will improve competitiveness of Titan brands particularly. So we are very, very positive. As far as LTCG is concerned, I don't think there is a very, very direct implication for jewelry industry that way.
Okay, all right. Hi, Mr. Santalia. Good morning and good to see you, Ben. Well, what about the inventory loss? It's going to be a positive for sales, but there would be some inventory hit that we should be looking forward to as well?
So we talked about, Nigel, that we had certain inventory, which was custom duty paid. And that will flow through our P&L for the next 6 months as that inventory gets sold in the market. And that estimate, one-time loss estimate, is ranging from 500 to 550 crore.
So that will be in the next 2 quarters, Q2 and Q3 we'll see that impact, right?
Yes.
Got that. Also, we'll get back to the numbers, but there have been large conglomerates that have entered the space. And it could get a little bit competitive. How do you read this? Birlas and Reliance are, making their presence felt out there. The market's big enough for all to exist, or do you expect the competitive intensity to hurt?
So competitive intensity in organized players is definitely going up, Nigel. But overall market is very large, and the secular trend of organized sector gaining over unorganized is intact. So I'm sure there is a space for more organized players or organized players expanding. Yeah, temporary, there will be cycles of intense competitiveness and then, settling down. Perhaps we are going through right now that. And but we are okay. As long as market is getting organized, people are looking for brands which they trust and which they like. It's okay.
Sir, let's talk about the jewelry business in particular and some more trends here, because I believe the share of studded did not really go up much in the quarter gone by. What is the trend? I mean, is this a one-off? What do you forecast for the rest of the year as we get into festive? And also for the jewelry business margin, where you've been talking about maintaining those margins above, I think, 11.5%. Now with this new pricing dynamic coming in with the duty cut, etc., what's your expectation and guidance for the jewelry business EBIT margin?
So as far as margin is concerned, our Q1 delivery of EBIT and EBITDA margin has been in line with previous Q1, and we don't expect anything significant changing as far as remaining 3 quarters are concerned. You are right that while studded overall in absolute amount is growing, but the growth rate is slightly below gold jewelry rate. Gold at this point of time, from the investment angle point of view, perhaps is slightly more appealing to the consumers. and high value diamond and solitaires are slightly at a slower move, which of course affects our margin profile overall for the jewelry business. But we are able to maintain by working on various cost levers, various margin improvement program. So we think that margin for the remaining of year would be around the same line, while competitive intensity is there. But I don't think we are looking at price cuts or squeezing margin to kind of defend our market share or grow our market share.
So can you give us the band again, sir? When you say they'll stay around the same lines and level, you're at about, I think, 11.2% in Q1.
Right.
So
overall 12%, we have talked about in last annual investor day also, that domestic jewelry should be anchored around 12%, could be plus minus a little bit here and there, but that's our target to be achieved by us. Yeah.
Okay, and Mr. Sundalia, this includes, I mean, coming back to all that talk about competition, higher sort of spending, marketing spending, etc. I mean, you're accounting for all of that. Will we see that, by the way, higher spends?
Not very significant, but wherever the jewelry industry is very, very regional and catchment based. So wherever we find that, and we keep mapping our competition from city to city and catchment to catchment. So of course, something more to be done on the marketing, and which we will not shy away. But that should not be so significant that we need to tell about margin impact.
And, I've asked you this before on lab-grown diamonds, that still remains very insignificant? I mean, in terms of...
Yes, compared to the US market, what we saw, markets are very different. In India, still it is a slow start, I would say. And that might have created, of course, some noise. And that is where you see high value studded and maybe solitaire slightly slower than rest of the portfolio. We will wait and watch how maybe lab-grown diamonds are recruiting new customers in India, and they are likely to do that compared to US, where the diamonds was already very, very penetrated category. So we will wait and watch. We are kind of keeping our eyes wide open on this development, but so far it is still not affecting customer sentiment so much.
All right, Mr. Sundalia, we'll leave it there. Thank you very much for your time. Great speaking with you. It's always a pleasure having you with us. That's the management of Titan. Stock's down about 1.5%. I mean, I think there is about a 50-odd point recovery on the Nifty, which has come through. We were down about 500 plus points. We are down 450, 24,266. We'll have the intraday come up on your screen. It doesn't look like a sharp sort of jump or anything. It is not, but it is about a 50, 60-odd point recovery from the day's lowest point. I mean, advanced decline has also improved a little bit, 10:1 in terms of declines to advances right now. And I just want to make a quick mention of a few names here. Motherson is down 6%, if you can have that up, about 182 on Motherson. There is LIC Housing, which is down 5.5. So now volumes are picking up. I mean, they were kind of lacking in the morning. Titagarh is down about 4%. Phoenix, I mentioned earlier. CAMS is down about 4.5%. And Kalyan Jewellers is down about 5% right now. KNR Construction, Electrocast, Sobha, Sudarshan Chemicals, Nucleus. Nucleus, of course, is the big 10% plus cut. Otherwise, you're basically looking at between 5 and 6, 7% cuts coming through across the broader markets right now. On the upside as well, there was very little which was doing well, but there are a few things now which are actually up and up in a pronounced way. So UPL, of course, 1.5% at the day's high. Sun is up a full 1%, 1.25% actually. And delivery, which we highlighted with Mangalam earlier, is up another 1.6%. Actually, delivery is the top volume traded gainer across the board right now. Look at Newland Laboratories. Newland went up, I think, 20% on Friday. It's up another 6% this morning on significant volumes. There is D-Mart, Avenue Supermarts, which is up 1.5%. So now it's kind of opening up a little bit with a lot more clean signs. For example, I can spot 2% higher. Dhanuka Agrotech is up 5%. TTK Prestige is up about 3.5%. Senco, another jeweler, is up about 1.25%. So I think, a more sort of things are starting to settle down and people are venturing out on the long side as well, as you can see from some of these names that I mentioned.
Well, that's right. You know, Prashant, and if you look at it, even some of these insurance companies have come off the low point of the day. SBI Life was down closer on 3%. That's recovered a goodish bit. Remember, these have been underperforming sectors, you know, but the insurance sector has come back, and now SBI Life as well from the low point of the day has seen a good fight back. HUL, well, that's been a rank underperformer. Just take a look at that stock. It's moving higher. Why are these FMCG stocks looking good? Well, maybe a coalition government would mean further, focus on rural India. Also, we know that now pricing growth has come back. For the last year or so, we haven't seen any pricing growth. But that's coming back as well. So that's why it appears that the FMCG index is somewhere that the bulls want to hide out there. And it's a good recovery, actually, from the low point of the day. As we speak, we're at around 24,300. Holding on to this pullback is going to be extremely important. For the time being, slip into a short break. You come back. We'll continue focusing on the top stocks that are moving around. We also get Nagaraj Sethi of HDFC Securities, who will be joining in for some technical trades.
Welcome back. We're focusing on some specific stocks now. UPL is on the radar. Remember, the numbers weren't too great, but it seems that some of the brokerages are being a little optimistic to see the volume growth. Let's go across to Sonal to understand this better. Sonal.
Well, yeah, 16% volume growth, that is something that the street seems to like. And the second part is reasonable valuations. That is something that could provide support to the stock and is providing support to the stock today. Jefferies is a buy call with a target price of 665 rupees a share. The company reported a net loss in Q1. However, the healthy volume growth of 16% is something that offsets sharp price decline, and management has retained its FY25 outlook in terms of guidance as well. But Jefferies has gone ahead, cut their EPS by 2% for FY26 and 27, while FY25 cut is sharper as well. HSBC also has a buy rating with a target price of 635 rupees a share. According to them, also first quarter was a miss versus their estimates, but volume growth is something which they are positive about. Stability in prices and inventory rebalancing is key to recovery from here on, and the company is talking about rights issue, other initiatives which could cut down their debt. That could be another positive for the stock. Investec remains a seller on the stock with a target price of 385, which is a big decline from the current levels. Management indicated price decline has been largely arrested and they do not expect any further decline from current levels. The stock trading at 17 times is one of the cheapest in the agrochemical space, and it is a large manufacturer of agrochemicals. So by that scale, they like the valuations. And on the back of this, the other agrochemical space stocks as well, insecticides, Dhanuka Agritech, all of them are buzzing in trade today.
Okay, all right, got that, Sonal. Thanks very much. So UPL managing to buck the trend in such a weak market. We got a 2% pop on that stock. Let's go back and revisit LIC Housing Finance. This is a stock reeling under the earnings impact. Vamakshi, back to you. So just tell us where the weakness was.
Well, absolutely. Let me first start off with the disbursements. Disbursements came in at 12,915 crores. This is a sharp fall of almost 29% sequentially. The disbursements, however, were up nearly 19% on a YOY basis. Because we're seeing a very sharp fall in the deposits, the AUM growth was also rather muted. AUM at 2.89 lakh crore was up only 4.4% on a YOY basis and up only 0.6% sequentially. On AUM growth, the management believes that clocking 10% growth for the year looks quite challenging. However, they aim to clock nearly 8% plus growth as far as the AUM is concerned. The NIMs also fell for the company. They came in at 2.76% as compared to 3.15% seen in the previous quarter. The management is now guiding for NIMs to range between 2.75 to 2.8% as compared to an earlier guidance of 2.7 to 2.9%. NII too is seeing a downtick, down nearly 10% YOY and 11% sequentially. NII has also come in much lower than what we were expecting. The asset quality, however, remains steady for the company. GNPA stands at 3.29% with NNPA at 1.68%. But the net profit has also declined by nearly 1.8% to 1,300 crores. So overall, it's a weak set coming in for LIC Housing Finance. We're seeing muted growth on the AUM and the NIMs have contracted.
Okay, all right. Thanks a lot for that, Vamakshi. By the way, you know, from the FMCG pack, ITC has taken support around its 20 DMA. Now, if you can pull through the low of the day, it's around 479 rupees odd. The 20 DMA, you know, that comes in at around 474 rupees. And from there, in fact, it's seen a good bounce. So ITC, given its weight on the index, that's going to be the important one to track. If you plot that 20 DMA, you know, it'll give you a better picture in terms of the support levels as well on the technical basis. So keep an eye out on that one. But the stock that's getting a hard hit, well, it's Bharat Forge. Sudarshan joins us to fill us in with exactly why. Sudarshan.
So Bharat Forge is in focus. The stock is sharply lower and it has slipped to lowest levels in last 2 months. And this comes after the release of North America class truck orders. And this North America class truck orders have come in at a 15-month low. And it's the fall is for the second straight month. It has fallen both month on month and year on year. For the July orders, it's down 8% year on year and down 5% month on month. And FTR analyst, FTR is the body which releases North America class truck orders. Its analyst says year to date order levels are marginally below historical average and seasonal expectations. Also, but market fundamentals remain relatively consistent. And now the focus shifts to earnings, which company releases on August 8.
Okay, all right. So those North American truck orders not looking very inspiring. Thanks for that, Sudarshan. So that's another stock in focus. Now, SBI, of course, has been reacting to numbers. It was a bit of a mixed bag. I mean, overall, not much issues, except the fact that provisions and slippages have been slightly on the rise, and a bit of a compression in margins also came through. In a conversation with CNBC-TV18, SBI Chairman Dinesh Kumar Khara commented on the bank's positioning to move yields forward on the impact of LCR on the lender. Take a look.
I hope that we should be in a position because whatever increase in deposit rates have also happened, even our MCLRs have also gone up of late, and we will be in a position to have the better yield on advances. Our yield on advances have already moved to about 8.86%, and we should be in a position to improve our yield on advances going forward. So that is something which will help us in ensuring that our NIM, we should be in a position to protect around these levels. We are having a pipeline is about 4.76 trillion, and it is equally split between proposals in pipeline and also proposals which have been sanctioned but awaiting disbursement. So I expect that, of course, you know, when it comes to these corporate proposals, the disbursement takes some time. It does not happen immediately. But yes, of course, a significant portion of that, at least part of it, will be awarded. This is what we expect. So I think I expect that we should be in a position to maintain our earlier guidance of about 14 to 16% kind of a growth, and more towards 15% kind of a growth. As I mentioned, that these are all temporary aberrations. That is something which has caused these slippages, and I don't expect that it will have any permanent impact on the book. And all the subcomponents of the book are faring well, and we have actually seen that SMA 1 and 2 as compared to previous year have also come down from about 9,300 in the first quarter in the previous year. It is now somewhere around 7,900 odd crore. So that is something which we have seen. So I think it's a very clear reflection that when SMA 1 and SMA 2 are much lower, that asset quality is not a challenge. And also, if at all you will look at the slippage ratio, it is actually 10 basis points down as compared to the first quarter of the previous year.
Okay, well, that is the SBI chairman on specific bits there. We'll come back and play out more of that. But let's bring in our technical experts as well. Nagaraj Shetty of HDFC Securities is with us. Markets are at about back above 24,300. So for now, it does look like the low of about 24,200 has held. The low today is 24,192 to be precise. Nagaraj, what would you recommend one do here?
Hi, good morning, Prashant. Nifty has been a downtrend after forming a new all-time high around 25,080 odd levels. I'm expecting some more decline in the short term, and probably around 24,000 is going to be a good support for the market, and I'm expecting upside bounce. For the short-term traders, one can go for a short in the F&O stocks, and for investors or long-term traders, probably wait for some more decline, probably around 24,000 to bounce back from lower levels.
Okay, so that's the sense of the Nifty. Nagaraj, just quickly, I mean, there's a lot of selling in auto stocks. This started even before the big global sell-off, right? We saw that even as the monthly sales numbers were trickling in. M&M now is down 3%, Maruti, etc., all lower. Any trades here? Maybe on the downside, if not the upside, or would you stay away?
Better to stay away because already auto sector has already declined in the last 3 sessions, and today's candle formation in sector itself is not that great for the bears. I think better to stay away at least for 1 or 2 sessions to get the things clear, and one can enter at the lower levels.
Okay, let me ask you about the other side as well. It's very clearly a risk-off day, so it's all about FMCG and pharma, Lever 1.5%, Sun, Nestle, Tata Consumer, Britannia. In this entire pack, just technically, what looks like the strongest stock? What's the long trade that you'd take, if at all?
In FMCG has reacted from the downward. I'm not that bullish on the FMCG. I'm expecting further consolidation in FMCG. And in pharma, looking attractive at this point of time. It has been a resilient during weak broader markets. And in Dr. Reddy and Divi's Lab are the one, they are showing some strength at the lower levels at the current point of time.
Nagaraj, your own trades this morning?
I don't have any trades in the scripts discussed as of now.
Okay, all right. No individual sort of trades at all, right? Got it. Thank you very much, Nagaraj. I mean, I think not having a position, not having a trade is also a trade. So that is Nagaraj Shetty of HDFC Securities. So 400 points lower. We are slightly above the 24,300 level. We'll take a break. We are back. We put the focus on commodities, which I think are also selling off. Oil was down 3, but it's not just that. There's more happening. Manisha on the other side. Stay tuned.
Okay, about 400 points down on the Nifty, but let's figure out what's happening in the world of commodities. We have Manisha with us in the studio now. Manisha, yen carry trade, non-farm payrolls, Israel and Iran. I don't know what all to look at this morning, but you tell us, what does it all mean for commodities today?
Well, not so good, really. You know, you could have seen a lot of safe haven premium come in for many of these commodities, but even that is not coming. Remember, the dollar index is now trading at a 5-month lows. We've broken below 103, and many of these are dollar-denominated commodities. But even with that, there's not so much of a support. That is the kind of risk aversion that we are seeing in the global markets. I'll start with the crude oil prices, though, and many of these industrial commodities actually ended July deeply in red, and August hasn't started so well for them in any case. The WTI crude prices are trading at an 8-week lows. You have Brent at a 29-week lows, and the crude products like heating oil is trading at an 8-week lows as well, and that's pretty much the case with other crude products also. Well, you have been looking at weak manufacturing data that has come in from US, from China, and from Europe as well. Add to that the US unemployment data that also came to the 2021 highs. The wage growth has been slowing. So the US manufacturing data, while that has been on the weaker side, most of the big corporate earnings also seem to be missing their targets, and that is what is weighing onto the space here. Well, yes, there are some positives as well, and is the reason perhaps you have seen some stability come in the Asian markets for many of these commodities. The Fed rate cut possibility for the month of September definitely seems to be supporting prices. The Middle East tensions, where we did see Israel airstrike hit nearly 2 schools there, and there are 30 to 40 casualties there as well. And then Iran warring retaliation is another thing. So the markets are getting bothered about regional war picking up in Middle East, and that should be adding some premium to prices, but we haven't seen that happen. OPEC and allies meeting also came and went, and they've stayed on course with voluntary output cuts from the month of October, so no changes there as well. But I do want to take you to the price movement that we have seen in case of crude oil prices in this current year. So we started this year on a weaker note in any case at 70 for WTI and Brent at 75. And as you can notice that the difference between WTI and Brent has been holding at around $5. That's exactly what we saw when we saw the prices run up as well in the month of April. So the first quarter for the crude oil prices was very bullish. So was the case in the month of April as well. And 86 and 91 also is a $5 range there. That's exactly what we saw when the prices went for a huge profit taking by the month of June. And then we saw some gains come in for July. It was still in 80s that we were trading, but the narrower range is now in play here. where you can see just about $3 of a difference between WTI and Brent there. And we have seen from those 80s to 70s right now. So from the highs that we saw in the month of July itself, we are down by almost $10, as you can see in both of these prices. And August is just about begun here. So in last 15, 20 days is the kind of decline that we have seen come in for both of these crude prices. Also, when you look at on a week-on-week and a month-on-month basis, we are down by 3% on week and 10.5% down in last 1 month itself for the crude oil prices. Much has been factored in right now, but what the street will watch out for today in the trade is, one, you have the US services PMI numbers coming in, and second, most importantly, you have San Francisco Fed President's speech as well. That would give you further guidance on what the interest rate cut could look like. As of now, 100% probability of a 25 basis points and 63% probability of a 50 basis point rate cut. I mean, things really keep getting interesting from here.
Okay, all right. Manisha, thank you very much for that. By the way, anything on the crypto markets, Manisha, that you've been tracking?
Well, very sharp decline. If you look at the Asian markets right now, we've seen Bitcoin, Ethereum both decline between 5 to 7%. But would be more interesting to see on how the Indian markets really pan out with the way WazirX really seems to be going. And remember, there are huge Indian participants who've actually been holding their holdings on the exchange there. And WazirX did come out with a 55-45 approach when it talked about letting people take some withdrawals or even trade here. But that has seen a huge backlash as well. What we do remember now is, what we do hope now is that WazirX is expected to come out with new proposal. That would be in the next 2 to 3 weeks as well. So maybe newer rules now for crypto and how Indian participants actually do take their profits or monies out of WazirX or crypto for that matter is something that the street will watch out for. But at this point in time, if you look at the last 1 week itself, crypto as a sector also has seen very sharp losses. So overnight, we've seen 5 to 7% of a decline. In the last 1 week, we are down by anywhere between 15 to 20% for many of these cryptocurrencies and altcoins.
All right, Manisha, thanks very much for that. So more on that as we go along, but that's a quick roundup of what's happening across commodities as an asset class. We're down about 430 points still, so 24,286, back under the 24,300 level. So there's a bit of a back and forth, but I mean, at least 400-point cut since the beginning of today's trading session. The low is 24,196, 192, I think, that was in the morning. And then from there, the markets picked up a little bit. So market breadth is slowly creeping up, but, you know, so we were up, only 200 stocks were in the green. Now we got 300 stocks in the green. And about 2,100 stocks, almost 2,200 stocks actually, which are in the red. So the advanced decline ratio on your should come up on your screen as well.
By the way, Prashant, I really want to mention this global picture is just not stabilizing. The Japanese market is now down 7.6%. That's the headline index, the Nikkei. The South Korean market is down 7%. So this huge pressure across Asia, that's unrelenting, at least as of now.
So in that sense, the 1.5% cut here it seems orderly. I mean, absolutely, it seems orderly here. I mean, there are some headlines that trading is being halted on this exchange, that exchange, all kinds of things. But here, I mean, you're down about 1.5%, 1.6%. So, you know, sort of entirely par for the course given what's happening in global markets. Well, we'll take a quick commercial break here. We're going to come back in just a bit from now. There is, of course, also the RBI policy decision, which is scheduled for later in the next couple of days. So we'll have our Citizen NPC show coming up. My colleague Lata will be in conversation with the CNBC-TV18 Monetary Policy Committee to discuss what the RBI will do in August. Stay with us.